Okay, today what we want to do is finish off what we started on externalities. You remember in the case of externalities, we're talking about welfare economics as well. The two go hand in hand. So the thing we've been discussing up to this point has been how the federal government got involved in trying to help people who weren't able to purchase a house, but made it easier and easier for them to do it. They took away the requirements for 20% down, took away the requirements for income proof, documentation, etc. In effect, by law and by different proclamations or what do you call it, mandates that were put out for by the federal government, they forced Fannie Mae and Freddie Mac to buy more and more mortgages that were subprime. But nobody told anybody who was the investor on the other side that these derivatives or investments that Fannie Mae was selling had subprime mortgages in them. It just sort of happened behind the scenes. Everybody was happy because what was going on meant that people in the inner cities, people with less than stellar incomes, were able to get into homes using these subprime mortgages. The end result of this whole process is that we ended up with 5 million homes going into foreclosure during this time period. It was disastrous. And really, the plan was good, and the idea that let's help these people because they're, not participating fully in what we expect or what we think they should have. So let's help them. But in helping them, we created a bigger problem. We put them in homes with mortgages they couldn't afford. The net result, 5,000 foreclosures. All right, so Fannie Mae, Freddie Mac are making a lot of money. This doesn't go unnoticed. And all of a sudden, we start to see develop in the lending world subprime mortgages. So let's talk about that. Angelo Mozillo was CEO of Countrywide Financial, and Countrywide was located in California, in Calabasas, just above LA. Great big huge building on the 101 freeway, the Ventura Freeway. And he got caught up in this idea of these subprime mortgages and got on the bandwagon that the government was on. Okay, let's make it easier and easier for people to get mortgages. For him jumping on that bandwagon, of course, he made more money. So his proposal was, let's eliminate down payments for low-income consumers, and he's talked about this at National Housing Conference Center in DC. And also, let's reduce the loan processing time so that the loans can get approved in minutes. So that was his thought process going into this whole idea of subprime mortgages and selling those subprime mortgages off to Fannie Mae and Freddie Mac. They wouldn't be stuck on his balance sheet. He'd get rid of them. So he partners up with Johnson at Fannie Mae, who we've already talked about. And Johnson says to Angelo, hey, Angelo, I like you a lot. So what I'm going to do is I'm going to charge you a lower fee than I'm charging your rivals. Now, if you think about that, that's against the law. That's restrained trade, etc. It's in clear violation of fair trade rules. So Countrywide becomes the largest seller of loans to Fannie Mae. And again, we talk about Fannie Mae, but this also includes Freddie Mac because they all did the same things. So Countrywide develops a processing system for loans called Fast and Easy. It was a computerized system, and the software was given to all their branches. They have branches all around the country. And what Fast and Easy meant was no required income, no asset documentation, and a debt to income ratio of 50%. Now, when we have class, get me to kind of go through that, but the standard operating procedure for allowing or underwriting a loan is a debt to equity ratio of around 35%. So 50% was a big, big improvement for the folks who didn't have a lot of income. So Fannie Mae and Countrywide. Countrywide, computerization of loans fast and easy by Countrywide. A former broker for Countrywide says, you know what, if a guy had 2 jobs, Baja Fresh and 7-Eleven at night, we classify him as a manager, and the computer system, again, fast and easy, would assume therefore he was a manager and assume also his income was $100,000, regardless of what he was actually being paid, and the loan would go through. So Fannie Mae really likes Angelo, and they began a customer engagement program to reach out to the key executives of Countrywide. They want to be sure that the people they're dealing with at Countrywide will send all their loans to Fannie Mae and Freddie Mac. That way, Countrywide makes money, Fannie Mae and Freddie Mac make money. In 2005, before the crash, Countrywide sold $12.7 billion of subprime loans to Fannie Mae. 2/3 of those loans were 100% loan to value. And I said before, if you have a loan on a house and it's 100% of the loan value, that means you are a renter with a mortgage. And if something should happen or the value of your home should decline, you're going to be in a situation where you're going to have a bigger mortgage than what your house is worth. The end result in this particular scenario, this 12.7 billion, was all of it became toxic. When we say toxic, we meant that it couldn't be paid back. Through this whole process and this time frame, foreclosures in the United States grew to over 5 million foreclosures. That's horrible. So we put people in homes that they couldn't afford and would not be able to afford. Angelo, let's talk a little bit about him. There he is, swearing in before Congress and before the judge. Cartoon of Angelo, very sad face. So Angelo, Condé Nast Magazine voted him the second worst CEO of all time. Nobody asked me who the first was, but let me tell you, the first was Dick Fuld, F-U-L-D, and he was the CEO of Lehman Brothers. Lehman Brothers, as a result of all of this nonsense, had to file bankruptcy in September, and with that, it was the largest bankruptcy in history, and it ended up with over 60,000 people worldwide being left or taken out of a job. CNN said this guy is one of the 10 most wanted culprits in the 2008 crisis. He co-founded IndyMac, which also collapsed, and we should have seen the handwriting on the wall. His income, he did a very good job of feathering his own nest, which means he gets all the money. His income from 2001 to 2006 was approximately $470 million. That's a lot of bucks. But he made sure he took care of the people who could do him favors. So there were friends of Angelo that got special mortgages. They would include Jim Johnson, of course, from Fannie Mae. Now there's a little bit of a conflict of interest there. Franklin Raines, who succeeded Johnson as CEO of Fannie Mae and got in trouble himself. Chris Dodd, who was a senator. Ken Conrad. Ken Conrad was forced to resign because of special loan considerations. Nancy Pelosi's son, who's still in the Senate, minority leader, and the House, I'm sorry, not in the Senate, but in the House, minority leader for the Democrats. Barbara Boxer, who's a senator from California. And 40 executives from Fannie Mae and Freddie Mac got loans through Angelo and were considered friends of Angelo. So the results were they got mortgages and they got very special treatment by Angelo and Countrywide. So 2010, they get Angelo for $67.5 million for securities fraud and insider trading in the stock of his own company. He got out as things were going down the tubes for his company and did very well doing it. But $667.5 million is a drop in the bucket for Angelo, and that was brought out in the newspapers at the time. Their political progress. He learned from our friend Johnson at Fannie Mae. He saw what Johnson and Raines had accomplished using political clout to get what they wanted from the Congress and from the government. Of course, Johnson was a specialist at this. He converted Fannie Mae from criteria for executive payments and bonuses that were the metric, or the criteria they were using was quality of loans coming into Fannie Mae. He changed all that, said that's bull. We're not going to do that. What we want to do is earn money. So everything is going to be keyed to return on investment, but more particularly profits, the bottom line. So Angelo takes a page out of his book. 1998, he made contributions politically of $60,000, nothing. But by 2003, he had bumped it up to 1.2 million. In 2005, it was $1.5 million in political contributions. The money was spent to stop new lending laws proposed by Treasury, the Federal Reserve, the House, and the Senate. The idea behind it was we have to keep this thing going. We have to keep getting people with lower incomes into homes. So let us do our thing, leave us alone type thing. He added key members to his board, including Henry Cisneros, who was Clinton's HUD director from 1993 to 1997. HUD is the Housing and Urban Development Group in the federal government. Robert Perry, who was former head of the Federal Reserve branch in San Francisco, the Federal Reserve District headquarters in San Francisco, District 12. So he added key members to his board so that he was sure he could keep going and keep the politicians at bay and thinking he was a wonderful guy. So their lending practices, a lot of this came out later, but let's go through it. Lending practice, no income, no documentation. The debt to equity ratio of borrowers could not be verified because of a lack of documentation. Debt to equity borrowing means that most criteria, as I said, 35% debt to equity ratio. That was thrown out the window. It didn't matter anymore. So no income, no documentation. If you tell me you made $100,000 next year, even though you can't document it, no problem. I'll make the loan. Nonsense, absolute nonsense. So the Wall Street Journal in 2012 said that Angelo gave Howard McEwen, Republican from California, a loan. And the process of the loan was virtually no underwriting. So Angelo directly said, take 1 point off the loan. So if the going rate for mortgage loans was 5% at the time, he got it for 4%. No fees, no garbage fees, okay, which means no points. Approve the loan and make it no documentation. In other words, they just gave him the money because of who he was, Representative Howard McEwen, Republican from California. So Countrywide would lend up to 95% of a property's value. 2002, Maxine Waters thought, this is great. Let's take it a little bit further. The dream, the American dream, the down payment initiative. If you're a renter, you don't have to make a down payment to buy a home. That was 2002. Again, you don't pay down and you have a mortgage, 100% of the value of your property. You are a renter with a mortgage. So within 2 years, Countrywide would be writing no money down loans with abandon. And guess what? Selling them to Fannie Mae and Freddie Mac. Now, home equity extraction, subprime 2. So subprime loans started, as we discussed, for people of lower income status in cities, etc. But they also then came up with a whole new concept. At this time, the market for homes was increasing at sometimes as much as 10% a year. So we had a big bubble in home prices. The subprime lenders saw this as an opportunity to increase their income by loaning money to people who were well qualified. In other words, enable them to extract money from their mortgage and use it for other things. So it was called subprime 2. Alan Greenspan, who at the time was chairman of the Federal Reserve, said the surge in cash-out mortgages refinancing is likely to improve rather than worsen the financial condition of the average homeowner. Now, Greenspan is president and head of the Federal Reserve and did not see what was going on. His philosophy in life is pretty much libertarian, which means the government should leave things alone. So even though the average homeowner's financial condition was worsened actually in reality because they borrowed more money, the theory was the price is going to go up anyway, so you're in good shape. You'll get your money back. You'll be able to pay off your loan. 2008, borrowers extracted from their homes $750 billion. That's a big chunk of money. And they spent most of it on personal consumption, home improvements, credit card debt. For instance, all right, now it's time to buy the Mercedes. The loaning company, the bank, just gave me $100,000 off of my mortgage from my house, the value of my house. Let's go spend it. So let's put improvements in the home. Let's reduce our credit card debt. But what they really did do was they went to Disney World. They bought a second home. They bought Mercedes-Benz instead of Fords, etc. And lo and behold, the money was gone and spent. If housing prices did not continue to climb, and in fact decreased, they would be in deep trouble. And that's exactly what happened. So the Fed issued a report saying, hey, we're in good shape, no problem with mortgages. But the study they did was flawed. And I think it was the Federal Reserve Bank in Boston that did the study. And instead of looking at mortgages by themselves, homes that had mortgages, they included in it all real estate, which included real estate for even older people who had paid off their mortgages and or had low mortgages on their homes. And as a result, the study was flawed. They didn't have the right data. They didn't use the right criteria. So everybody says, no problem, we'll keep going. So subprime mortgage options. This is a cartoon I picked up. As an alternative, this is your loan broker talking to you. As an alternative to traditional 30-year mortgage, we also offer interest-only mortgage, balloon mortgage, reverse mortgage, upside-down mortgage, inside-out mortgage, loop-de-loop mortgage, and the spinning double axle mortgage with a triple Lutz. Anybody who's watched the Olympic skating would know what that is. So alternate A from 2004 to 2006. Remember, alternate A is a product that was designed by these lenders to allow people to take money out of their homes. They could refinance their homes, take out a second, and take cash out of their homes. 2001, 2006, home prices were growing at mostly about 10% in metropolitan areas. Raines, who took over from Johnson, got in trouble. He lost his job because of accounting fraud. He was cooking the books so that he and his executives could get higher raises and bigger bonuses, and got caught. So Washington starts to worry about this stuff. Remember, they turned Fannie Mae into a private corporation. So their mentality and their thinking was that we have no exposure. But lo and behold, since it is a government-sponsored entity, if they get into trouble, who's going to have to bail them out? Good old Uncle Sam. Who is Uncle Sam? Good old taxpayers. So Fannie Mae was doing a couple of things. They were maintaining profitability by holding mortgages, which gave them big exposure. In other words, particularly if there were subprime mortgages in the mix. And they're hedging their risk with other derivatives. So they were doing some funny things themselves. Alternate A loans, short-term loans to individuals that qualify but are refinancing to monetize the equity in their homes. That's exactly what it is. You monetize the equity in your home. It's a short-term loan, in other words, 1, 5, 7 years. Most of them, I think, that were written at this time were 5-year loans. So GSEs and alternate A. Well, here we go. We gotta bring the Fannie Mae's and Freddie Mac into this picture. 1 in 5 mortgages to the GSE insured or bought were either alternate A or subprime. That's a lot. Let's see what that meant. By the end of 2005, 2007, Fannie had $350 billion exposure on alternate A and another $166 billion in subprime. Now, when we say they had an exposure, what we mean by that is they were holding those loans on their own balance sheet, and those loans were beginning to look very, very shaky. Freddie Mac, doing the same thing Fannie was doing, had $205 billion of alternate A loans on its balance sheet and $173 billion in subprime mortgages. They were in just as bad a shape. Balance sheet debt to equity got as high as 60-1, which is absolutely crazy. Affordable housing, the original concept behind this externality, the original concept was to get people part of the American dream into their own homes and provide the opportunity and the wherewithal and the money so that they could afford to buy a home and live in a home. The American dream. The theory behind it is if you own your own home, you're going to work harder to keep it. And as a result, you will be better off because you will work harder. Now, the problem is this whole concept drifted into the background, and alternate A became the big call card for lenders, for these lenders. So affordable housing was no longer the concern. It was more about making money. This is a list of the subprime 25 lenders, top 25. These 25 accounted for $987 billion, almost $1 trillion worth of loans. Okay, so this is a big guy, big thing. The total of all high interest lenders was $1.4 trillion. So there's a lot of money out there that's subprime. The biggest lender, of course, was Countrywide Financial, 92 million, almost $92 billion. I mean, it's crazy. Now, all of these 25 subprime lenders would go bankrupt. They no longer exist today. They were either bankrupt or absorbed by another company. For instance, Countrywide got picked up by Bank of America. Bank of America spent the next few years paying penalties for all the funny stuff that Countrywide did. Wasn't a good investment for Bank of America. But the key here is that these guys are gone. All right. So the bubble burst. This is Case-Stiller U.S. House Pricing Index, and you'll see what happened. House prices continued to climb and climb and climb until we got to the peak around 2006, 2007. By 2008, it had started to fall precipitously. 2009, it was back to where it should have been originally. 2010, 2011. Interesting chart. If you look at that, you could almost draw a regression line from a level of the index at 100 to where it is today back to 100. You can pretty much see what happened. Okay, and if as a result of the bubble bursting, we're back to normal where we should have been in the first place. Now bubbles burst. You guys now have got to be careful of this type of thing. Question came up in one class today. What about the housing bubble in Texas? Well, the housing bubble that's occurring in Texas, values are increasing quite rapidly of homes. Biggest reasons for that in Texas is there's a lot of people moving to Texas. A lot of companies moving out of other states, particularly California. Toyota, for instance, going to Plano. I think it's TD Ameritrade, or maybe somebody else is going to Southlake. These are big moves, big companies moving a lot of people to Texas. Could it happen here? Could it happen again? Sure, it could happen again. I don't think we have the subprime problem that we had back then, but what we could experience is if you look around, builders are building around Texas like crazy. Everything you get their hands on, they're building. There's a tremendous shortage of labor to work on homes and apartment buildings. So one of the things that could happen that we've got to be careful of is the builders could overbuild. And as a result, you'll have inventory just sitting around with nobody living in it. That's one possibility. I think people today worry more about student loans and also debt to equity ratios on cars. A lot of cars were bought with zero down, and the loans will come due in 3 years. So those are two of the major concerns today. What happened? The bottom fell out and we fell into what's called a vicious cycle. Housing prices declined. People with homes, a lot of them, most of them, particularly the 5 million that declared, that ended up foreclosing, their homes were worth less than the mortgages they created. Remember, they took out more money on their home. They took the equity out of their home by doing alternate A loans. As a result, the third box down, you have a choice. You either walk away from it, involuntary foreclosure, or if you're able to hang in there, you keep paying your payments, even though your mortgage is down below, or your mortgage is more than the value of your home. It all depends on what people do. And as I said, 5 million walked away, 5 million foreclosures. So what happens to the banks? Mortgage payments decline. The value of the mortgages decline. Banks incur losses. They have less money to lend out, so they restrict lending. Economic activity slows and unemployment increases. And guess what? We start the cycle all over again. The supply of open or unoccupied homes increases, and that forces homes to decline further. And that's what's called a vicious cycle. And that's exactly what happened as a result of the subprime mortgage crisis. Okay, that's it for today. I'm going to remind me in class on Tuesday, or Thursday rather, to take you through how you qualify for a mortgage, what the mortgage companies look at today. And I'll take you through what it takes to get a mortgage and what things they use as criteria to obtain a mortgage. So, at any rate, have a good weekend, and I will see you on Thursday.